studying your last two. I swim with tea when they turned in. The staring down to mute. And can lend a pole that some kid died.
Imagine opening a client's accounting records at year-end. In most owner-managed businesses, the shareholder loan account doesn't contain just one or two transactions. It often contains dozens of everyday entries that have accumulated throughout the year. You might see personal groceries paid from the corporate bank account, mortgage payments made by the corporation, personal credit card bills, or cash withdrawals taken by the owner. Every one of these transactions increases the shareholder loan balance because the corporation has paid a personal expense on behalf of the shareholder. On the other hand, you'll also find transactions moving in the opposite direction. The shareholder may deposit personal cash into the business, purchase office equipment using personal funds, or temporarily lend money to the corporation during a cash flow shortage. These transactions reduce the shareholder's outstanding balance, or may even create a balance where the corporation owes money back to the shareholder. This is why the shareholder loan account is rarely a record of one single loan. Instead, it is a running history of all the financial interactions between the shareholder and the corporation. For tax preparers, this account tells a story. Each entry must be reviewed to determine whether it represents a personal expense, a business expense paid personally, an owner contribution, a reimbursement, or a temporary advance. By the end of the year, the shareholder loan account becomes one of the most important accounts in the general ledger because it summarizes all these day-to-day transactions in one place. The key takeaway is simple. A shareholder loan account is not just about borrowing money. It is a collection of everyday financial transactions between the shareholder and the corporation. And maintaining accurate records throughout the year is essential for preparing an accurate tax return and avoiding future tax problems. A tax preparer's job is much more than entering numbers into accounting software. One of the most important responsibilities is reviewing every transaction to determine whether it is a business expense or a personal expense. This simple question has significant tax consequences. When an expense is incurred for the purpose of earning business income, such as office supplies, computer equipment, advertising, business travel, inventory, or utilities, it is generally recorded as a normal business expense. However, when the expense benefits the shareholder personally, it should not be treated as a business expense. Instead, it is usually recorded in the shareholder loan account because the corporation has paid a personal expense on behalf of the shareholder. Common examples include groceries, mortgage payments, personal vacations, shopping, school fees, and home renovation costs. Although these payments may have been made from the corporate bank account, they are personal in nature and must be accounted for correctly. This is why experienced tax preparers carefully examine receipts, bank statements, invoices, and supporting documents. Every transaction is reviewed individually before deciding where it belongs in the accounting records. A helpful way to think about the process is to imagine a simple decision tree. First, identify the expense. Then ask, was this incurred for the business? If the answer is yes, record it as a business expense. If the answer is no, it will often belong in the shareholder loan account instead. This careful review process ensures that business expenses remain separate from personal spending, resulting in more accurate financial statements, a more reliable shareholder loan balance, and fewer problems during a CRA review or audit. The golden rule is simple. The first job of a tax preparer is to separate business expenses from personal expenses. Once that distinction is made correctly, the rest of the accounting and tax treatment becomes much easier. As tax preparers, One of the most valuable things we do at year-end is review the shareholder loan account for errors before the tax return is prepared. In practice, most shareholder loan issues are not caused by complex tax legislation. They are caused by simple bookkeeping mistakes that accumulate throughout the year. One common mistake is recording personal expenses as business expenses. For example, if personal credit card payments, groceries, or home expenses are charged to the corporation and left in expense accounts, the financial statements will be incorrect and the shareholder loan balance will be understated. Another frequent issue is the corporation paying the shareholder's personal mortgage or other household expenses without properly recording those payments in the shareholder loan account. Sometimes the opposite problem occurs. The shareholder contributes personal money to the business, but those deposits are never recorded, making it appear that the corporation owes less than it actually does. Missing receipts and incomplete documentation create another major challenge. If there is no evidence explaining why a payment was made, it becomes much more difficult to determine whether it was a business expense or a personal transaction. Tax preparers also encounter transactions with little or no description. A bank statement may simply show an electronic transfer or a check, leaving the accountant to investigate what actually happened. That is why year-end reconciliation is so important. Every transaction should be reviewed. Necessary journal entries should be made. Supporting documents should be collected. And the shareholder loan account should be reconciled so that its balance accurately reflects the financial relationship between the shareholder and the corporation. A simple conversation with the client often solves many of these issues. Rather than asking, "Who paid for it?" the better question is, was this expense for the business or for personal use? The key takeaway is that most shareholder loan problems are preventable. Good bookkeeping, proper documentation, regular reviews throughout the year, and a careful year-end reconciliation make tax preparation much easier and significantly reduce the risk of CRA reassessments.